take a rocket scientist, which is useful because I'm not one, to reflect on the changes introduced by the autumn statement and think about which of those are of greatest relevance to investors and SME owners. So when you look at investors, definitely those continued frozen thresholds, allowances, exemptions are definitely something to consider and factor into planning. The reduction of the threshold above which you pay additional rate tax, that's another one to factor in. Absolutely, the stepped reduction from 2023-24 in the dividend allowance from 2,000 down to 1,000, and then in the next year down to £500. And of course, similarly, the reduction in the CGT annual exemption, quite a big reduction, of course, from 12,300 to 6,000 next year, 23-24, next tax year, that is, and then down again to £3,000 a year after that. So all of that has to be factored in. And of course, the non-reinstatement of the 1.25% additional national insurance will also have to be taken into account by SME owners, as will, of course, the increased corporation tax rates when they become relevant, which is pretty soon, isn't it? And if they become relevant to you as a company with your profits more than £50,000 and certainly more than £250,000, we've got that marginal rate, haven't we, between £50,000 and £250,000. In relation to investors, and I will be doing some separate videos on each of these points, but in relation to investors, a point that has been talked about much over the last week, certainly talked about by me and some callers, people sending in emails, is the impact that that reduction or those reductions in the dividend allowance and the CGT exemption will have on wrapper choice. And I think, this is the bonds collective thing. Once you're beyond the so-called tax no-brainers, point here is this, and as I said, I will be looking at this in more detail, and there will be a bulletin on this in more detail, is that the fundamentals of decision making haven't really changed. What has changed, in my opinion, is the threshold has dropped, the threshold above which considering a bond for its tax deferment and tax management qualities becomes more important. Because of course, if your income from the investment is going to be tax-free, if it's an equity dividend, then within the dividend allowance, or if it's an interest distribution within, say, your personal allowance or your personal savings allowance or the zero starting rate, that any of those things, and then you've got CGT freedom on the investment, then you don't really need the tax deferment and management qualities of a bond. But if those levels are dropping, i.e. the dividend allowance and the CGT exemption, then the threshold above which you should consider a bond will be lower, because the amounts that you can generate tax-free from your collectives will be lower. Of course, that fact also has to be factored in to plans that have been set up, say, to use your annual CGT exemption when you're extracting money year on year from your collectives and feeding an ISA. So I'll be looking at all of these issues in a bit more detail in future videos, but there are a few things to consider to get you thinking about and looking at, hopefully, the Techlink bulletins, where many of those points have already been covered in some detail, and I'll be continuing to cover them in videos.